So thanks a lot for taking some time out of your day to join us. Today's webinar is called Flossing for Your Finances. And this is meant to be focused on personal financial strategies specific for dentists. So I'm Lukas Fleck. I'm an associate portfolio manager here at PWL. And I'm joined by my colleague today, Brady Plunkett, and he's a portfolio manager at PWL as well. Our goal today is to make this as interactive as possible. So we're using a software called menti.com to facilitate some two-way interaction between you guys and the presentation. So feel free to scan the QR code on your screen. That will bring you to the website and get you all linked up. You can also go to menti.com and enter the code that you see. If you miss it on this slide, don't worry. At the top of every slide, you'll see the same code repeated throughout the presentation. Give you guys a second here, but like I said, don't worry if you miss it.
Cool. Thanks, Lukas. And worst case, we also have a live chat where we've got an advisor at PWL answering questions. His name's Ben. He's awesome and he's very responsive and he's fast. So if you've got a question about something that we've said and you don't want to unmute, I don't know if you can actually, but please put it in the chat. You can go from there. So here are some subsections of key topics that we are going to be covering today, specific to dentists. Do I incorporate? The concept of a holding company, optimal compensation, bringing taxes down, all sorts of things that we get questions about from incorporated professionals and definitely dentists in our day-to-day at PWL. If we're to move ahead, Lukas, we do have some bad news. It's not going to include any pitch on whole life insurance. We're really sorry if that's why you registered today. And in all seriousness, insurance is an important concept for dentists. It's just outside the scope of today's presentation, but definitely term life insurance and disability insurance for most professionals. And in some niche cases, permanent insurance can be interesting, but it's just not what we're going to dive into too deeply today. We are going to start with a key question of, do I incorporate? For many dentists that are getting into practice, their income starts to escalate. This is a key question that they typically have is, do I, or if not today, when? For to move ahead, we're going to actually ask and poll you guys, true, false, or I don't know. I should incorporate ASAP. These are some dramatic emojis here. I kind of like the second one, but that's not true. I get a kick out of him. Poor Ted Danson, he's not getting a lot of love. Five, 3, 1. Maybe some are still logging on to Mentimeter. There's 4. Here we go.
There we go. We have a true.
Yeah, splitting the room a little bit. 6, 4, 2. I guess people come here for information. This is awesome. Well, we'll go ahead, Lukas. We'll start with one of the key factors to think about when incorporating. So as I mentioned, when you move into dental practice, I guess one reason why some people get into it is the fact that your income really starts to escalate. And what you're seeing here is this massive waterfall. So as income starts to escalate noticeably, think about a waterfall for all of this income showing up and having it all generated on a personal tax return or just showing up personally. In many cases, that can very much be a surplus for what any family or individual might actually need. So this starting point of a waterfall is really what you see and where people start to ask questions. Okay, well, how do I become more tax efficient with how much I actually draw? And what are some options available to me? And that's where the corporation really comes into existence. So that waterfall in this second diagram is halted by a bit of a dam. So if you think about the concept of a corporation, by incorporating, you are now creating a dam or like a barrier to stop income coming to you personally that you don't need. That is one of the beautiful benefits of a corporation, is it serves as a wonderful tax deferral mechanism. So rather than taking all of this income and paying high marginal personal tax rates for income that you don't need, dental professionals have the option of incorporating to keep income in the company and then draw from it later, ideally when their needs are at a different state and when their personal tax brackets are much lower. But as you do that, one of the big concepts is, okay, we've got this money showing up. I can choose to keep it in the company, or I can choose to draw from it personally. One of the complementary points in thinking through this decision is to remember that there are a lot of advantaged places personally to save money. These are namely RSPs, first home savers accounts, and TFSAs. Some of these are gifts created by the government that allow you to save excess cash in these accounts in a tax advantaged manner. The RSPs, FHSAs, TFSAs, they've all got different purposes. They've all got different rules. We're not going to go into line by line what each of these rules are, but in most cases, generally, it is better to save in these accounts before you start saving in the corporation. But you have to be mindful about using these accounts strategically in alignment with what your goals actually are, because there's certain rules that pertain to each of these, like purchase of real estate, like going back to school, that you need to be cognizant of before you start saving there. When you think about incorporation, that the concept of higher cash flow and earnings potential is definitely one of the biggest factors to consider. But beyond that, you want to think about your lifestyle needs. And that kind of cycles into debt repayments, that fourth point there. Have you purchased a home? What level of cash flow do you have to sustain? Do you have kids where there's higher expenses in your family? Do you have a mortgage because perhaps you've renewed and higher interest rates are requiring you to take more out of the company? You have to understand what you actually need to spend personally in alignment with whether or not to incorporate. Is this a practice that you could sell? And if so, you actually need to create a corporation structure in order to sell a practice down the road. That's another good reason why dentists choose to incorporate. Like we mentioned, the RSPs, FHSAs, TFSAs, is there a more tax efficient place to allocate savings personally before the corporation? There's also a final point in here about maternity leave. So what we see sometimes is that dentists postpone incorporating because there is a goal that to start a family. And if they're going to be away, not earning income, expenses are a little bit higher, it might make sense to postpone the decision to incorporate because there's not enough value to satisfy a corporation until their income starts to change.
So on a similar notion to the question of should I incorporate, another question that we get a lot is, should I set up a holding company? So a second company, you're already incorporated. Do I set up a holding company in addition to that operating co? Separating liability is one of the main reasons to separate an operating company and a holding company. If you have a liability that comes up in your operating company related to your business, having the investment assets in a holding company can provide another layer of protection. Now, this needs to be set up carefully and with the advice of your legal and accounting team to ensure that true liability separation actually exists. And it's also important to note that liability protection can often be solved, at least in part, with insurance. So for example, medical malpractice insurance is a very important part of your business. Rather than having a separate entity, malpractice insurance does a large part to limit that liability that you're taking on. But while that's essential, it's not a complete solution for all potential liabilities. You can think of other liabilities that exist in a business, whether that's a billing dispute or if you own the real estate that your practice is operating in, somebody slips and falls. There's other forms of liability that can arise. Of course, there's other forms of insurance that exist to help with this, but having a separate company in place to separate your assets into is just another part of a more holistic risk management approach. On top of this, an estate freeze can be a very important estate planning tool to reduce your terminal tax bill and potentially avoid paying multiple layers of tax upon death. So if you have a large amount of value accumulated in either an operating company or a holding company, it may be your goal to eventually pass these assets on to the next generation. An estate freeze is essentially a way to lock in the value of your company at a point in time and transfer the future growth to a different shareholder. That might be a child or multiple children, or even a family trust. And we'll get to family trust a little bit later. But this effectively results in a deferral of taxes on the growth of your business. And you're no longer taxed on that growth at your time of passing, but rather those new shareholders who you've assigned those shares to. Estate freezes, they could be a topic for their own webinar. There's a lot to cover here, a lot of different types of estate freezes, but a holding company can be an important part of this estate freeze structure. And another big reason for dentists specifically is the idea of purifying the operating company for the purpose of accessing the lifetime capital gains exemption. So if you want to sell your business, there's limits in terms of how much you can have in passive income inside that business if you want to access the lifetime capital gains exemption. For those of you who aren't aware, the lifetime capital gains exemption helps shelter capital gains triggered on the sale of qualifying Canadian business shares. This amount, as of the start of 2024, was just over $1 million. And actually, in the 2024 budget, they've proposed increasing this amount to $1.25 million. So it's a substantial amount. And on the screen, you'll see a few different criteria that are noted. One of them being that 50% of assets used for active income there must be 50% of assets used for active income over a 24-month period. So it's important that you consider the possibility of a sale well before the sale actually occurs and get the proper structure in place. Otherwise, you might miss out on utilizing the lifetime capital gains exemption. Another quick reason I'll mention is if you do plan to purchase assets within your operating company that aren't directly related to the business, you may run into an issue. So most provinces, for example, won't allow you to have real estate that's not directly related to your practice. This differs province to province, and there's nuance here, but that could be another reason you might consider setting up a holding company. I mentioned we touch upon the family trust. So related to both estate freezes and the lifetime capital gains exemption, a family trust can be a really important tool to have as a part of your corporate structure. It's less useful for dentists as a place to hold an investment portfolio, since that will typically be done within the company itself, whether that's the operating company or the holding company. But rather having it as a shareholder of the company can be very useful. Related to the lifetime capital gains exemption, I mentioned that threshold of $1.25 million. If you have a family trust in place and they hold non-voting common shares of the company, you can actually multiply that lifetime capital gains exemption amount across multiple beneficiaries of the family trust. So that could be your spouse, that could be your children, that could be parents, grandparents, and basically anyone. Now, there are some considerations, of course. If you allocate income to a beneficiary of a family trust, that individual is owed the money. That doesn't need to be paid out right away, but in effect, you will need to satisfy that liability at some point in time. And so just consider that before adding, a distant cousin to your family trust just to take advantage of their lifetime exemption. You might actually need to pay them the money. Also, if a portion of your child's lifetime capital gains exemption is used, this means that later in life, they will lose access to that part of their capital gains exemption. So if they're in the same shoes that you are later in life and they're trying to do their estate planning and they're practicing and they're possibly going to sell their business, they might run into an issue where they find out that they've already used a large chunk of their lifetime capital gains exemption. So just some items to consider there. In the case of an estate freeze, rather than giving direct ownership of the company to the next generation, so rather than giving your children shares of the company, you can have a family trust in place where the family trust owns shares of the company. You could be a trustee of that and still retain some control and a little bit more flexibility.
Awesome. Thanks, Lucas. If you're to, I'm just trying to envision like a bit of a case study. So let's say you have decided to incorporate, maybe not a holdco, but at least like a dental pro corp. Okay, you've bought a house, your family is underway. Okay, and now you're back to practice. You're earning income. I would honestly say, when you look long term, one of the most important financial planning sources of support that dentists should look for is the best way to pay yourself. When you look long term across your entire career, getting that decision that's based on evidence, is considerate of the values of what's in your corporation, what your needs are personally, and considers the personal and corporate tax characteristics, is going to make a huge impact. If we go to the next slide, what we actually want to survey those in the audience today is, what has your compensation strategy looked like today? This is usually pretty interesting. Just dividends, just salary.
You tell me. Nice.
Yeah. Usually it's a bit all over the place. And if you're comfortable writing in the chat in terms of how your compensation strategy was devised, typically it's just a conversation with an accountant. We would love to hear about it. But in working with incorporated professionals like dentists, this was one of the key challenging topics that we really needed to zone in on and create a better answer for. And we're going to take you through a little bit of our methodology today in terms of what goes into that. Bottom line is, it's not a one shot, this is going to be the answer for the rest of your career. It truly is a bit of a dynamic decision where we go back to it and reevaluate periodically. That's so fascinating, eh? 17% just there, 17% just salary. That's so cool. Anyway, if we were to move on a bit, salary, dividend, or hybrid, is there an optimal approach? We'll keep it going, Lukey. What you'll see here is just a high-level summary of the pros and cons and just the basic differences of salary versus dividend. Salary, what paying salary does is it creates RRSP contribution room that enables business owners to save in an RSP or a spousal RSP as well for their spouse, depending on the income splitting opportunities there. When you look long term, and especially as you approach age 40, what that RSP contribution room can actually evolve into is IPP contribution room, which we're going to chat about in a little bit. Paying salary does reduce corporate taxes with the deduction, and up to, it's called the YMPE, certain level of salary, I think that's just around $70,000 in 2024, that enables maximum contributions into the Canada Pension Plan, which is obviously a bit of a polarizing topic if you've been on Twitter the last few months or so. But that is a separate income stream that you can draw from in retirement via the Canada Pension Plan. The Rational Reminder just actually had the chief actuary of the Canada Pension Plan on the podcast. It's fascinating. Go have a look. Dividends on the other side do achieve a lower personal tax rate right up front when you compare that to the tax rates of what salary would yield. There are no CPP contributions that are required from paying dividends. But you do not create RSP contribution room. And for a long time, it was very commonplace for some accountants to just look on a very short-term basis to say, listen, dividends are going to be interesting to think about without the CPP. And without creating RSP and just looking at the lower tax brackets. But you have to be a little bit more expansive about that. If you go to the next slide, what CRA and Department of Finance actually wants to achieve is at least very close to an equalization of where a personal business owner will be, whether by paying salary or by paying dividends. It's called integration after corporate and personal taxes are accounted for. And the next slide gives a bit of a summary. And this is typically what we do find, is that salary is a little bit more advantageous from the concept of integration, but it is very close. And one of the different metrics that we're gonna have to consider now is the higher corporate capital gains taxes that are now being applied, and how that changes the compensation strategy that business owners are looking at, because that does impact the concept of integration. But you can see on this slide, holding all else equal, salary is a little bit better off. But what Department of Finance wants, it's for it to be very, very close. Now, if we keep that moving, we talked about the benefits of salary in terms of creating RSP/later IPP contribution room and allowing you to pay into the Canada Pension Plan. There are also extremely important attributes of paying out dividend income, especially by what we call notional accounts of the corporation. A notional account is not like a real account with actual savings in it. It is a tax tracking mechanism in the corporation based on various levels of tax the company has paid on different sources of income. These are extremely important to understand because what they represent is additional value that could be had by paying dividends based on whatever these notional account balances are. We're going to go through them one by one. We'll try and fly through them. And they're going to be in order of generally what the most valuable notional accounts of a corporation are. Before we get into it, you can find out what your notional account balances are by checking out the last copy of your T2 corporate tax return, or you can email your accountant. And in some cases, especially with the capital dividend account, you can request for a cost for CRA to verify that and get back to you. And we were doing a lot of that in the lead up to June 25th when the corporate capital gains tax inclusion rate, changed. And we were considering triggering or deferring capital gains in corporations. Anyway, the first one is a due to shareholder. This is straight up, I'm a business owner. I've loaned money into the corporation. There's a tracking of what that loan has been, and you can pull it out without any tax implications at any time. That's easy, it's straightforward, and it's very important to consider when thinking about drawing from corporations. The next one is a capital dividend account. So this is a notional account that builds value when the corporation realizes a capital gain. Now, post June 25th, 33% of gross capital gains are actually credited to this account. And as that account grows, it represents money that can be withdrawn on a tax paid basis to the shareholder. I say tax paid because the corporation has already paid tax on the other 2/3 of the capital gain in this example. There's a lot of letters here, and some vowels might be out of place. We're just going to clarify what these are. These are refundable balances to the corporations. The E represents eligible dividends, refundable dividend tax on hand, and the N represents non-eligible refundable dividend taxes on hand. So these are two different buckets. The E RDTOH is more valuable than the N RDTOH. I'll explain in a minute. But how these build they're generated from certain types of investment income that are received by the corporation. So let's say there's an investment portfolio. I'm not talking about standard revenues or earnings. We're talking about investments like a GIC or an investment in Enbridge or Royal Bank or an index fund, if you want to think of it that way. Lucas will chat about that a little bit later. But as income are paid from dividends, interest, and capital gains, there is a tracking in these two different buckets of income tax that the corporation has paid from receiving those. The E represents eligible dividends from Canadian-based companies like Enbridge and like Royal Bank as an example. That is refundable to the corporation when you draw a dividend and release eligible dividends from there. That is, I would say, right after the CDA, that's one of the most second valuable buckets to think about, is releasing the ERDTOH because it creates a refund to the company directly. The non-eligible does result in a bit of a refund, but the difference between the eligible and the non-eligible is on a personal shareholder basis, you are taxed less favorably from that dividend than you are with the eligible dividend. because if a personal shareholder draws from the ERDTOH, you also have the eligible Canadian dividend tax credit personally that you're able to report, but you don't with the non-eligible NRDTOH. Now, these are tracked separately in every corporation, and similarly, you can ask your accountant or look at your T2 for what your options are to do that. The key is, though, if you leave these be, they're going to erode over time. So when you think about the best way to pay yourself, it does in many cases make sense to release these balances because they are not going to grow unless certain types of investment income are received in the corporation. Go ahead, Lukey. The other notional account is the general rate income pool, GRIP. So corporations are subject to the small business deduction up to $500,000 of active income received in each corporation. And if you have a very successful corporation, you might actually report earnings beyond that. That isn't subject to the small business rate. For extra income beyond that, it is taxed at a general corporate rate, which is tracked. And inside that is actually what this account's called, the GRIP, the general rate income pool. It's a little bit higher than the small business rate. But once you pull it out, you can pull it out as an eligible dividend. And it does not give the corporation a refund, but it still is valuable to release as this bucket builds up. So I know that's a ton of information. I'm really sorry. We're probably in the weeds a little bit. If you're looking for a framework for how to pay yourself, this might be a pretty cool list to think about. Number one, just identify your personal needs. Do you have a mortgage? What are your set of expenses? Are you going on a trip? What are your upcoming needs? Two, account for uncontrollable income sources. So maybe on a family basis, your spouse isn't a dentist and they've got straight salary income from other sources that are coming no matter what. Or maybe you, in addition to being a dentist, you're a professor at a local college and you've got salary income that you can't stop or something like that. Account for uncontrollable income sources. Three, consider clearing out the notionals. So all of those other accounts that we looked at do erode over time with inflation. Consider absorbing those. And four, or consider the long-term benefits of salary. We chatted about RSP / IPP contributions and the concept of CPP. I would definitely believe that you would need a long-term financial plan tailored to your individual needs to give you perspective, long-term perspective on the value of establishing salary and what that mix is in terms of just salary, just dividends, and then a hybrid of each. Number five is don't forget about the gifts that the government is giving us, mainly RSPs, FHSAs, TFSAs, also the RRSP we haven't chatted about, but there's some opportunity for government matching where you need to get money personally to access that. The other thing to think about is strategizing around income splitting with your spouse, depending on their situation, and understanding whether there's merit in actually assigning a level of salary to them, if that's possible, assuming that they're not a shareholder of the corporation and they can't draw dividends from there. But if there's a certain level of, I'm not sure, bookkeeping or support to the corporation that you can actually provide, it's actually commonplace to assign a certain level of salary to income split on a total family basis. The individual pension plan I mentioned a little bit earlier is the evolution of the RRSP. You'll see on the chart at around age 40 there on the right, the contribution limits to an IPP for those in their early 40s start to become much more valuable than the RSP can otherwise provide. Looking long term, this can become quite a difference maker in a financial plan, especially if you're expecting to work into your 60s at some point. What that does is it can reduce the amount of passive investments your corporation maintains, which then enables the corporation to access more of the small business deduction and not let passive investment income get in the way of that. The IPP is like an RSP on steroids. It's something to definitely consider for those that are approaching 40 or at least in their 40s too. You don't want to rule it out if you're in your 40s or early 50s, but you do want to model it in alignment with your needs and objectives. Okay, but let's say that you're retired with savings in your corporation. Now, how do you pay yourself? So we've got what we call a generally accepted withdrawal algorithm here in terms of looking for the sequence of where to draw from to create your retirement income and which buckets should they come from. We're going to start at the top. If you've got a RIF and you're in your 70s, or you've already converted your RSP to a RIF sooner than that, you're going to have minimum withdrawal amounts to take out. The next bucket's very interesting. So CPP, QPP, OAS, these are public pension benefits. You have a decision and the choice to apply for these benefits from CPP from 60 to 70, from OAS to 65 to 70 as well. And you're going to want support and guidance in terms of figuring out what the optimal time of applying for these pensions looks like, given your situation. Underneath, you'll actually see the notional accounts in the corporation that you want to draw from by way of dividend income. And after that, you'll see if there's assets in a personal taxable account, non-eligible dividends from the corporation, additional RIF withdrawals. A lot of times when you're thinking about, long-term planning, it's less valuable to have money in a RIF from the concept of estate planning, because it's a huge tax bill if something were to ever happen to you. So you want to deplete those as soon as you can. And the final buckets left over are TFSAs and trusts. But all of this needs to take place in a holistic, tax-considerate financial plan that you want to build for your family.
Well, thanks a lot, Brady, for the deep dive on all things corporate compensation related. There's a lot there, as you can see. I'm going to go a different direction here. We're going to talk a little bit about how to fit debt into your long-term strategy. I mean, as dentists, I'm sure many of you have likely needed to manage at least some level of debt, likely early on in your careers or maybe during your studies. So we wanted to make sure that we touched upon this and talked a little bit about how to fit this into your long-term strategy and just how to think about debt in general. Before I get started, I would love to hear from the group what emotions come to mind when you think about debt. And this is all anonymous, so feel free to share as much as you want. There we go. Stress, scary. Very common. We'll get to that. Fear. Needed, absolutely. We'll talk about that. Opportunity, we'll chat about that as well. Leverage, yep. Depends. This is all fitting right into our presentation. This is good. Cool. So debt, saving, and investing, these are all really important tools to have in your financial tool belt. They allow us to move economic value or money through time. So with debt, you can advance future earnings to today to cover off some consumption needs. In the case of investing, it's sort of the opposite. You take current consumption, you set it away for a period of time to access in the future. When people are young, they usually have little to no financial wealth. So you borrow money to finance things like educations, homes, starting a business. And as your financial position tends to improve, you'll slowly start to be able to save for a rainy day. And then as it improves even more, you start setting aside larger amounts of money to eventually fund a retirement. So using debt early in life can make a lot of sense. And somebody said necessity when they thought of what comes to mind when they think of debt. And it absolutely is necessary for a lot of people. It can also make sense due to something called the diminishing marginal utility. So I'm going to use an analogy here. I know you guys are all dentists, so maybe you eat a little bit less pie than the average person. I don't know. You can think about pizza, whatever you want. If you were to consume one slice of pie a day or one slice of pie every few days, you'd probably get a lot of value from that. As opposed to a contrary scenario where every week, once a week, you sat down and ate a massive pie all in one sitting. Debt's a little bit like that. So it lets you spend some of your future wealth today. Instead of starving today and being stuffed later on, you can consume your lifetime wealth pie in little chunks over time. Obviously, it's more complicated than that because we also have this strong emotional relationship with debt, like we saw, and that can change how we use it. So debt can be scary for a lot of people, and particularly for people who grew up in a household that struggled with debt, because debt can truly be one of those things that crushes people financially if it's not used appropriately. So that brings me to the notion of good debt and bad debt. And somebody teed this one up for me as well, so thank you for that. So we'll talk about some of the reasons. For applications like investing in large indivisible assets, so things like a home or an education where you can't really buy a single share of your own education, for example, it's almost a necessity. And it's a prime example of what good debt is. Borrowing to fund your education in a field like dentistry is a fantastic way to advance your human capital to create financial capital in order to then build up human capital to later pay off that debt. An example of bad debt, it really comes down to values. So this might be, buying a lavish sports car and a line of credit, not because you value cars or want it, but more so because somebody at your practice has a nice car and you think that's something you should do. A mental model for thinking about debt that I think is really important to grasp is that spending while you're in debt is logically equivalent to taking out a loan. So what I mean by that is that you're choosing to consume now rather than repay debt for past consumption. That then prolongs the loan, which is effectively an action of borrowing. The reason I think this is so important is that if somebody needs to borrow from a line of credit, for example, to make a purchase like I just described, they're probably going to feel some of that fear or scariness that often comes along with debt, and they'll think a little bit differently about that decision before moving forward. But if you're spending cash while debt is still sitting there on your balance sheet, it's not going to feel the same, and you might be a little bit more inclined to spend that money freely. So I think it's an important lesson just to keep in the back of your head, if you are carrying debt, to think about when you spend, it's almost like borrowing. So just be conscious about what you're spending on. I'm not saying put every dollar you have towards debt. You need to live your life. But having that balance there is important. So the main question that we get when it comes to debt is, do I pay off my debt or not? And now, again, like most financial decisions, the decision to pay down debt is not purely mathematical, but it's a combination of both math and psychology. So leaving debt outstanding can make a lot of sense mathematically, whether it's because you have a low after-tax rate of interest on that debt, or maybe even no interest in the case of a student loan. If redirecting the funds that you would otherwise be using to pay down that debt towards assets that have a higher after-tax expected return than whatever interest rate you're paying on your debt, it can make a lot of sense mathematically to leave that debt outstanding. Now, this, of course, adds risk to your financial picture. You have a known liability on one side of the balance sheet, and on the other side, you have assets growing at an unknown rate of return or sequence of returns. But in theory, there can be that argument for it. On the flip side, from the perspective of psychology, like we saw with a lot of your responses, debt can have a negative impact on subjective well-being. So studies suggest that credit card debt and student loans negatively impact life satisfaction, and being in debt is associated with high levels of stress, anxiety, depression, reduced marital satisfaction, and reduced job satisfaction. So all these things can be a reason to pay off your debt, even if mathematically you might be inclined to keep it. So what is the best way to invest? I'm going to take a second and poll the group here. and ask if you had to rank the following criteria in terms of importance when selecting a fund or manager to invest in, what would you select? And you can rank these 1 through 5. There we go. It's got fees, manager reputation, Morningstar rankings.
It's nice to see past performance at the bottom.
I was going to say, yeah.
Yeah.
Good. We've got a pretty smart group here. Yeah, past performance being at the bottom. I mean, every time you get a pitch deck, you're going to see past performance is not indicative of future performance or something along those lines. So yes, past performance is not a great way, especially short-term past performance, not a great way to select fund managers. So happy that that's 5th. You guys are correct. Fees tend to be the best determinant in a fund's ability to generate investment returns. And I don't mean that the most expensive funds are the highest quality funds. And a lot of things in life, that tends to be the case. I don't know, the most expensive car is the best car. Not the case when it comes to investing, and it's quite the opposite. So as you can see here in this graph, the red bars represent the quartile of funds with the lowest fees. So the bottom 25% in terms of the amount of fees that they charge. As opposed to the gray bars, which represent the top quartile in terms of fees that they charge. So the most expensive, 25%. You can see that across a lot of different asset classes and strategies. In every single case, the least expensive funds outperform the most expensive funds. And this seems really intuitive, or at least simple to grasp. But honestly, I can tell you it's hard to tell when there's always a great sales pitch on the other side. And so you'll hear things like these are high conviction funds. We've got the smartest managers, the most complex algorithms, what have you, in order to justify the higher fees. And so this decision starts to become a lot more challenging, just behaviorally. To illustrate the effect of fees and why they're so important, let's just look at this little visual here. So if you gather returns from a lot of different funds, we're going to end up with a distribution somewhat like this. So we're going to have a lot of funds that perform very close to the average. Some will perform much better. Those would be on the far right, and the funds that perform far worse on the far left of the distribution here. Now, this is all without fees. Once you introduce fees, it pushes the whole distribution to the left. So it makes it worse off. And what you're left with is a very small corner of funds that actually outperform the benchmark. Now, I'm sure some people might be looking at this and saying, well, I'm just going to select the funds in that red corner. Why would I select the other ones? And just to test how difficult this is, I'm curious if you guys could answer. Just put your best guess in for the percentage of US equity managers, so active US equity managers that tend to beat the market over a 10-year horizon. Anywhere from 0% to 100%.
Is this the last 10 years, Lucas?
No, just over a 10-year horizon. And I think my data set ended in 2022. Each decade, it does remain fairly consistent, though. Good. I'm seeing a lot of answers at the left-hand side of this. So the answer, let's see if I can get it to show up. There we go. The answer is actually about 2%. So very low. If we look at our distribution here, so you can see that over a 1-year horizon, so US equity funds, they're represented by this middle bar, the blue bar. Over a 1-year horizon, about 42% of active managers underperform, or outperform rather. So still less than the 50% that one might expect without fees. But you can see how quickly this drops off. So over a 3-year period, this goes from 42% down to 6.1%, then down to 4.1, down to 2%. So the longer your time horizon is, in general, it becomes more and more challenging to outperform a lower cost benchmark. I threw in a really important term a little bit earlier on. I said active fund managers. So I think it's important to unpack that a little bit and define what is active and what is passive, because there's no true single definition of either. So just to make sure that we're on the same page, an active manager would be speculating in order to try to beat the market, whereas a passive manager would be buying, by and large, the entirety of the market in order to be the market or replicate the market. Why would we go with a passive strategy and own the entire market? There's a really interesting concept here where most stocks on their own as a standalone are bad investments. Stocks as a whole, though, tend to be great investments over most time periods. But all of those returns are explained by the best 20% of stocks. The bottom 80% of stocks collectively returned 0% from 1989 rather, to 2015. So once again, there's two takeaways here. Try to avoid the losers and pick the winners, which is very hard to do, or own the entire thing and benefit from the huge impact that the winners give you. And this is very simple, tax efficient, and inexpensive to do. This whole notion of owning the market means that you're no longer relying on a single person or a single team to pick securities that they think are underpriced or overpriced and will outperform the market as a whole. So you're no longer reliant on subjective judgment, but rather the collective wisdom of the entire market. And so we do this fun little exercise with groups every now and then where we ask them to select how many jelly beans they think are in a jar. And we get some pretty wild responses. And so this is actually a true scenario where the range of guesses range from 409 jelly beans to 5,365. The actual answer was 1,670 jelly beans. And the average came out to be 1,653. So very close. And what this shows is that the collective wisdom of the group is extremely powerful. And now we're doing this experiment with maybe 100 people, a few hundred people tops. You can think of every trade in the market as being like a guess at what the correct price is. So when a buyer and a seller come together, they're agreeing that the current price is fair and they're willing to accept a trade at that price. That's as if they're voting on how many jelly beans are in the jelly bean jar. So you can only imagine with $775 billion in daily trading volume around the world, the sheer amount of information that's being taken into account in market prices is staggering. So you or your fund manager, you might be incredibly smart individuals, but being smarter than the collective wisdom of the entire market, it's a really high benchmark to overcome. So what's the answer then? In a nutshell, it's index investing. And there's different forms of index investing, but in effect, it's buying low-cost funds that are broadly diversified and do not attempt to speculate. So we're not here to recommend a specific product to you. That's far from the purpose of this webinar. But overall, embracing an evidence-based philosophy, such as a low-cost indexing portfolio, you'll be setting yourself up for the best opportunity you have for a positive investment experience. So with that, I think that concludes our webinar for today. We'd like to welcome any questions. We can get a little bit of a discussion going. If you do have questions after the call, feel free to scan the QR code on your screen and schedule a meeting with us. I think Ben's going to be sharing a few Calendly links as well in the chat that you can click on and schedule a call.
Yeah. Just going to see if there are any questions here. Any in the chat? Are there any that we missed, Lucas? I'm looking in the chat. Any on Mentimeter that we didn't click enter on, or did we get everything? And if we didn't get your question, please feel free to resubmit it in the chat. Good. Okay, good. One of the things that I definitely wanted to share with the group is I'm going to call it the Money Scope community. I'm going to share it to everyone right here. This is an amazing financial planning curriculum for dental professionals. It is co-hosted by Dr. Mark Soth in Hamilton. He's not a dentist, but he's a physician, and there's a lot of parallels to the analysis that he has worked on with our Chief Investment Officer, Ben Felix. There's fantastic episodes via a podcast and written materials on there that are absolutely free to check out. There's one question in the live Q&A here, Lucas. Are there dangers to index investing? What do you think?
I mean, there's dangers to any investment strategy for sure. You take on market risk, and there's certainly dangers when it comes to market risk. I can say with certainty that there's going to be periods of decline, probably some extended periods of decline. One of the biggest dangers with any investment strategy is your own human behavior. And so that can't be avoided with index investing. If during a market downturn, you haven't set up a long-term portfolio that's appropriate for the risk that you're willing to take on, you might bail on the strategy at a really inopportune time. That might mean losing money. That might just mean having, far less in terms of investments that will be compounding over time. But that's certainly a risk there. Market risk is a good thing, though. There should be some risks to investing. Without risks, you get the risk-free rate, which is far lower than a portfolio of stocks. Stocks and bonds, like corporate bonds, carry risk as well. I think that's a good start to the answer.
A few other things is that just the concept of ETFs. Like in Canada, ETFs are known as this comforting, low-cost, passive structure. And if you're investing in an ETF, you're in a good place. Over the last 10 years, that's kind of been the shift where mutual funds had this really bad rep, but by investing in ETFs, you're in this safe zone. Unfortunately, manufacturers of these products in Canada can totally abuse that, where you're outside of what constitutes a great investment experience. But if you're investing in, let's call it, I don't know, a Japanese ETF, and not to pick on Japan, it could be any country, like a single specific country ETF or a single specific sector ETF. You could have a US consumer staples ETF where you're only accessing a very small population of the marketplace, and you're sacrificing a ton of diversification. But meanwhile, you're an investor that's feeling good about yourself because you're buying an ETF. Unfortunately, manufacturers have totally abused what the original concept of an ETF was. You can construct a bucket of literally anything. So the follow-up question is, should we just buy the index like SPY or QQQ? Short answer is yes, but you want to make sure that you're more, I would say, generally speaking, globally diversified than just the US market. There's some great asset allocation ETFs that Vanguard has come out with, and iShares, that are available for purchase on public exchanges. An all equity suggestion that you might consider checking out is VEQT. And that embodies more than just the US market. That's fully geographically diversified amongst and isn't focused in on a country or a sector. The other question that sometimes comes up is like, are there dangers to index investing? Like, what happens if too many people index, and what's the impact on capital markets? And we've thought about this. And if too many people index, what that doesn't create is ongoing price discovery, because there's not enough daily participants in the market that are trading and contributing to what a current market price of a given stock or ETF could be. Active managers and passive investment managers actually go hand in hand. they actually need each other to succeed a little bit, because if there were no active stock selectors or portfolio managers and everybody just indexed, well, there wouldn't be enough price discovery, and all of a sudden there'd be all these opportunities to buy undervalued companies that haven't increased in price because not enough people are trading. So it actually wouldn't last for very long, or we wouldn't expect it to, in a capitalistic model.
It's sort of the self-policing game there.
Does that mean active investing becomes more valuable as more people index invest? You got to be really good at it. I'm sure to a degree it might be a little bit true, but the question is, how do you go about it? And those figures that Lukas was mentioning, like 2% in terms of beating the index over rolling 10-year periods, it's crazy to me.
So I think as a theoretical question, you can make that argument, but if we look at the data, we are so far away from indexing or active investing surpassing index investing as being more valuable. So yeah, maybe incrementally, like on the margin, it's the more people index invest, you might lose some like minute amount of market efficiency, but we're so far away from that being a reason to not follow a strategy like index investing.
I think it's like 90%, Lukas, actively manage in terms of the aggregate of the Canadian market, and 10% invest in low-cost index funds passively. I know that's different in the US, but I think that's Canadian data, not too far away. Yeah. Somebody asked, why does the IPP become more beneficial in your 40s and not earlier in your 30s? I think somebody's typing an answer to that. I think that's how I'm interpreting this properly. I don't want to overlap a good answer and process.
Does Mauer beat the market? I'm not sure. Brady, do you know?
Can we pull it up? We'll check their fees first. And if it's over like, I don't know, 1.3%, probably not.
And like, just to answer this question more broadly, there will always be funds that beat the market. I showed that distribution of performance. There will always be a fund in that corner that is beating the market, but is it pervasive over time? And I don't mean pervasive over, a 5-year period. Like, our investment horizon is typically longer than 30 years. If you're going to select an active manager that can beat the market for a period longer than that, I think it's going to involve a lot of luck. I don't think you can use any skill to select that manager. It'd be extremely challenging and difficult. And the lack of pervasiveness and outperformance really makes it challenging to do that. Like, if you have a manager that beats the market for 5 years, that's great, but they don't tend to beat the market over the next 5 years.
Yeah. There's another question in here. I know we're getting tight to 1 o'clock, but do you see there being risks with total return index type products? And they seem more relevant now with small business deduction grinding corporations. So I'm guessing, Jack, like you're referring to maybe some of the Horizons ETF products that you see with very low MERs. And what the capability is to transform interest or dividend income that'd be taxed less favorably in a corporation into capital gains income. Number one, unfortunately, after June 25th, capital gains income, I know it's still a little bit better, but it's not as better anymore because less is added to the capital dividend account once realized. 2 is the taxation treatment that they are able to achieve might not be permanent. There's a lot of sketchy rules with how these derivatives are being classified in the underlying funds. And I would suggest that CRA and Department of Finance would have the ability to restrict that favorable treatment at any time. And then all of a sudden the structure might be for naught. So you're taking on certain types of regulatory risk by investing that way for a tax benefit that is much less advantageous than it was, let's say, earlier in the year.
What is the liquidity like for ETFs like XEQT? For example, if you had $1 million you wanted to liquidate, how much slippage would you expect? I don't have a basis point for you, but XEQT, VEQT, they are widely traded funds. The liquidity of ETFs is supported by market makers, not just volume of trades. And so that keeps ETFs very liquid, whereby if you're trying to sell a large amount, and let's say, for example, there weren't enough buyers to support $1 million purchase on the other side for XEQT. Now, I think that would be rare based on their volume, but let's say that there was not enough buyers to support that. What would happen is that market makers would enter the market and basically offer to buy that basket of securities off of your hands. So that would help eliminate a lot of the slippage because the market for market makers is very competitive.
Benny's got a nice answer to dimensional coming. If we want to go to the next slide, Lukas, just before we don't miss that. We want to keep doing a lot of these, and we really appreciate the attendance and the participation today. This has been so much fun for us. We love interacting with this community for sure. If you guys wanted to just fill out a feedback survey just to give some thoughts on what you thought went well and maybe what we could do better for next time, we would be all into learning how we can make these a bit better. If incorporated, can you pay yourself a salary while on paternity/maternity leave, or does it have to be dividends? Typically, there needs to be justification for a salary that is paid. And if you're able to, share any levels of work that you've done in the company, maybe you weren't working full tilt, but maybe you're working on a part-time basis, you can work with your accountant to strategize around a salary level that you can draw from, but you typically need to have proof that you have been working in some capacity to earn that salary. Versus dividends, no, you don't have to be working. Okay. Well, thanks everybody. I think we ripped through most of the questions there at the end. We are going to keep flooding stuff out through our Rational Reminder podcast. Ben's got common sense investing YouTube videos. If you're on YouTube, that we that he shares periodically. We're pretty active on Twitter, and we'll keep and we'll keep bringing these back from time to time. So thanks a lot for tuning in.